Welcome to the Commercial Real Estate Investing from A to Z podcast. I'm your host, Steph Boldrini. This podcast is for everyone who wants to learn about investing in commercial properties. We get the best people in the industry to give you straightforward and practical advice that you can actually use in your investing. And in this episode, we are talking about net leases and single tenant retail spaces and how you can add value to these investments, how they have performed over the last year. We are talking with Randy Blankstein. He is the president of the Net Lease Advisory firm, the Boulder Group. He has over 30 years of experience in the single tenant net lease sector. He led the Boulder Group to a top 10 company national ranking for single tenant retail transactions. And he is also the chair of the Net Lease Summit Conference. Here we go. Randy, thank you so much for joining us today, and thank you for saying yes to my completely out of the blue call. I really appreciate it. But first, why don't you tell us a little bit about you?
Thanks for having me, Stephanie. I appreciate it. I'm a listener of the show for about 2 months now, so happy to be on. Quickly, got into the business a long time ago, which is 1991 to age myself. Went to work for a Chicago real estate firm, commercial real estate company, which has been since acquired, which is now JLL. And I ran the industrial portfolio for the Midwest for AT&T. And as part of running that, I was responsible for the garages where the service vehicles go at the end of the night. So they're all kind of freestanding facilities. And so I kind of got introduced to this net lease world, which is, single tenant, usually investment grade, long-term leases, and, kind of realized it was a marketplace. Since I'd handle these on a regular basis every day, realized there was a lot of activity, a lot of demand for it. It wasn't really an official sector at that point. There wasn't conferences and REITs and everything else. Net lease, they were just single tenant properties, but realized there was a niche. Wasn't a lot of people filling that niche. So decided to start my own, boutique investment real estate brokerage company focused only on single tenant net lease properties. And, that's still where we are today. Since 1997, been solely focused on this niche of triple net properties.
And I know it's been a great asset class to own during COVID as well. Let's set the tone just in case some people don't know the difference between net, double net, and triple net leases. What is the difference between them?
Single net properties, which we typically don't see in our little sector, but that it certainly exists in the marketplace. Usually the tenant pays rent and the property taxes, and that's it. So again, it's not the majority of the sector, but for single net, it's rent and property taxes. That's it. For double net, which is the majority of the sector, double net and triple net kind of are equal. Double net, the tenant pays taxes, insurance, and some type of maintenance. So, for example, we have some freestanding properties. Let's use Walgreens as an example, who used to be a double net, but now is a triple net lease. They converted, a while back. But, when they're double net properties, the tenant, again, is paying the taxes, the insurance, and some maintenance. So, Walgreens carved out, roof structure and parking lot as landlord responsibilities, which is pretty common for double net leases. And, sometimes there's maintenance obligation on the tenant, and then replacement is landlord obligation. And sometimes it kind of varies throughout the thing. Sometimes landlord has, all those responsibilities, but on double net leases, there's some type of shared responsibility or landlord responsibility for, those issues. For true triple net leases, the tenant's paying for everything. So on triple net leases, the tenant pays for maintenance, repairs, taxes, insurance. Everything is paid by the tenant. So there's very little to do. And, you just pretty much own a property that just gives you a return without having to do any kind of management of the property. It's completely passive. So obviously they're very popular, and, triple net leases are the most in demand because of the lack of day-to-day management of them. And because of their so little to do, 68% of people that own triple net properties own them outside of the state of which they're located in. So again, it's more of a national business than a regional business or a local business because of that aspect.
I'm super curious to hear if anything changed in the single tenant retail space over the last year. Can you give us an overview, please?
Yeah, I mean, look, the net lease part of the market is the most conservative and stable, and people buy these things. It's more of a defensive play, not offense. It's like buying bonds versus stocks.
Mm-hmm.
You want cash flow, you want certainty, you want long-term lease. A lot of people want investment grade tenants, so you just really want to collect the check, and the certainty of that is the beauty. So, besides for transaction volume going off the cliff in Q2 of last year because of COVID, it started to build as the year went on. And again, since this isn't the most exciting part of the market, not a lot changed on a day-to-day basis because, most of the huge majority of tenants continue to pay the rent. There wasn't many changes along the way. And, they performed as they're supposed to, which is, well in a down market, and you don't share the upside on a good market. So, they performed well during COVID, and they performed well during the financial crisis of '07, '08. Again, these are the sturdy defensive defensive part of the real estate portfolio. So they perform well. As far as buyers, buyers went to obviously things that were open, things that were essential, names like Walgreens, Home Depot, Walmart, 7-Eleven, CVS, McDonald's, things that were open, doing well during COVID, strong investment grade. They went long-term leases. It was a flight to safety. And those are the kind of names that people move towards. Additionally, as people looked at remote work and migration trends, people were focused on markets that were open and performing well. So, there's much greater focus on Texas and Florida, for instance, for geographic focus because there was a lot of remote workers who kind of accelerated trends of growth in those two states.
Let's jump into what are some value add techniques in the single tenant space from an investor's perspective. What can people do if they see, let's say, a dark Walgreens for sale or any other technique that may come to mind?
Sure. So while the majority of the sector by far is not value add, it's again, kind of core coupon clipping conservative. There are some areas where you can add value in net lease. Besides for dark properties like you mentioned, which are properties which have a few years left on the lease that the tenant still pays rent for, but they're not occupying anymore. You saw a lot of like Walgreens and CVS and Rite Aid, kind of a few of those went dark because of some acquisitions, and sometimes they had overlapping facilities, so they closed one. You also saw some of that with the SunTrust merger. You had excess facilities, but you're still getting rent on them, so you can kind of reposition, collect your existing rent, and try to upgrade a tenant. That's certainly one value add technique. Otherwise, people buy short term deals where they feel confidence towards a renewal, so they can buy a 1 to 4 year lease and try to get it extended or try to get a lease renewal. It certainly is a way to you've added lease term, you've potentially added value with the rent increasing. So that's another value add. And also people look for either improving metros that aren't being recognized or improving credits. So, people look at
Mm.
names like Caliber Collision, which is, non-investment grade, but people think on the way up in a growing sector. People look at, 25 to 50 unit franchisees and think like, there's consolidation in the franchisee sector. Maybe they're ripe for growth and I could be buying a 25 unit franchisee, but they could be acquired in a few years and it could be selling a 300 unit franchisee. So I think credit
Mm-hmm.
upgrades is certainly a way you can make more, you can add value. Again, and people are looking at some markets that are growing but not already valued very highly. So, I mean, everyone recognizes growth markets like, Raleigh, Nashville, and Austin and Frisco, but there's other secondary markets which are growing, which get less attention. Greenville, South Carolina, Knoxville, Chattanooga. Those are some of the kind of secondary names that growth could continue over the years, and people could be paying a premium for them. Also some people are speculating, much on a much higher yield basis and buying cannabis lease facilities, which trade at very high
Yeah.
cap rates because they're not legal nationally. And so, there's trouble financing them and other things, but people are buying them on the bet that, eventually they do get legalized on a national basis. And that would, there could be 3 or 4 basis of compression if that actually happens. So, those are some value add strategies within the space.
Oh, that is a really, really good point. My purple crystal ball tells me that it is going to get legalized for sure. So I think that's a very, very, very good idea to start looking at these kind of properties if you are in line with that kind of investment morally.
Yeah, understand if you believe in the concept and you're okay with it morally, yes. Being legalized would be a huge cap rate compression for where they trade now, which is a discount due to regulatory uncertainty.
Exactly. I know that there are 300 million things that people can negotiate on leases, but what are some super important things that you think landlords should definitely negotiate in these kind of leases?
There's obviously, tons of things you can talk to on lease negotiations, but really you need to focus on two things, because ultimately a lease is only as good as the credit and the financials behind the tenant and or the individual success at this location. Even if it's a large public company, you still need to know that this location's okay, so that you have a strong renewal probability. That's what you're trying to figure out here. So what you really need is store sales reporting for this individual location. You really want to know that the rent to sales is in line with the tenant average, with the market average, and that this is a strong performing location that will has a high renewal probability, because that's the biggest risk event in a net lease property is, will they renew at the end of the lease term. So no in-store sales takes a lot of the risk out of it. And again, a lot of lenders want them and a lot of buyers want them. So really important to get the store sales. Also for private tenants, franchisees, other people that aren't public, you really need the tenant's corporate financials, because again, even though this location may be doing well or average or what have you, it's still backed by whatever parent is ultimately the guarantee on the lease. And so you need to understand the strength of that guarantor. A 25 unit franchisee, some can have great balance sheets, some, not so good. So you really
Hmm.
need to know where the corporate stands. But again, if I had a choice between the two, I would want my individual store sales first, because even a bad franchisee, if this is the best location, they'll close other locations first and yours will still be standing, even if the corporation isn't doing well. So those are the two you should focus on.
So if you get that particular store sales, you also request the neighboring store sales as well to compare?
You can't get neighboring store sales, but what you can get is, the unit average for whoever the operator is. And again, most of these things have, known rent to sales. So, quick service restaurants, you really want to be under 8% rent to sales. And so you really need to understand, based on your current rent, how profitable the tenant is at this location. Number one thing for rent renewals, if there's ever relief, or if you enter into a situation like COVID, where they come back to you and say, hey, our store's closed for 6 months because of COVID, you can say, a lot of tenants came back to people and said, look, I need some rent relief. And they said, okay, but I need you to give me a 6 month, I'll give you 6 months of free rent or half rent. And, in exchange, I want 6 months of extension at the end of the lease term. And I want you to start reporting store sales on an annual basis. So
Hmm.
it's a good swapping mechanism, even for leases that you don't have when there's tenants looking for concessions.
Hmm. Can you share some horror stories with us? Maybe a top two or three horror stories that you've seen in these kind of negotiations?
I luckily don't have a lot of horror stories
That's
because,
awesome.
again, lucky for some extent, because the majority of our clients are fairly sophisticated, and I've never kind of encouraged people to go up there on the risk curve to buy, 1 to 10 unit franchisees are always very risky. They don't have an operations in place, they don't have a CFO, they just don't have some of the things that larger franchisees have that you really need. So maybe like 10 or 15 years ago, these things used to trade at 150 basis point discount to some of the better locations. But today it's like 25 to 50, because it's kind of a compressed cap rate environment. So I say, look, during the compressed cap rate environment, you need to go for larger franchisees, major metros, newer locations,
Hmm.
and kind of, pay a little bit extra for the higher quality, because you're not getting the discount between the highest and lowest quality is too tight historically today.
So, I am a lagger in terms of these online purchasing, but I finally just made my first grocery purchase online. And it was amazing. I loved getting my thing in my door and not having to carry anything anywhere. And I know this is going to be a slow trend, to potentially convert some retail to something else. But where do you see that may go in the future?
Well, look, clearly online has taken market share for the last 20 years and probably isn't done at this point. But again, it's not a new concept at this point. So a lot of it's already baked into the cake. And some of it was just accelerated through COVID, where, online obviously had its heyday and more people converted to it quicker. But, at the end of the day, it will. take out a lot of second and third tier players and shift some floor plans to smaller as online takes, a certain share of the marketplace. So, I mean, look, omni-channel, which is, kind of a mix of online and brick and mortar is clearly the way of the future. And look, there may be less stores and there may be less square footage in the future, and that's probably probable.
Mm-hmm.
But also, what the pandemic has proved is that there's a sector that likes to go shopping. There's a sector that likes to see people together. They like the experience, and the downside or dark side of online is returns are really hassle and expensive, and cause you to go to a UPS store. Now you're back into a store and back online for your returns. So there's not necessarily time and cost savings in regard to that. So again, online's going to keep gaining market share. But again, I think people will go online sometimes, go to the store sometimes, and more importantly, maybe you just go to the store for something on your way home to grab one or two or three items, but not a full grocery shopping. So again, I think it's a mix and match, and I think the retailers who are best positioned for this kind of new market are, the freestanding ones and people who've adjusted their footprints. I mean, I think you're going to see a lot of, for net lease, what's good is a lot of these people are getting out of enclosed malls
Yeah.
and going to freestanding locations, whether it's Lululemon or the Apple Store or Sephora or the Gap, because people just want to, at this point, a lot of them go to the store quickly on the way home or quickly on the weekend, get what they're looking for, and get out and move on to other things. They don't want to spend the full day shopping. So again, tenants who are adjusting to that new market are going to do well, and people that fail to adjust are probably not going to be around to some extent. So online is no question here to stay, and it's still gaining market share at this point. The question is, what is the right mix of online and brick and mortar, and that's the question everyone's trying to figure out at this point.
Wow, this has been so helpful, Randy. Is there anything else that you think is important for our listeners to know?
No, look, I think the main thing at this point is, look, it's a compressed cap rate environment with minimal supply. So you just need to be a little bit careful as to what you're buying at this stage in the cycle, which is, stay for the higher quality, the major markets, the investment grade tenants. That's where we are in the cycle. There'll be other stages of the cycle where cap rates, spread out and maybe interest rates go up, and then maybe you want to go to secondary markets and secondary tenants, but that's not the stage of the cycle that we're at the moment.
And I am actually curious, when people have a potentially a triple net property, what kind of services do you provide? Is it with finding tenants, negotiating leases? What do you actually provide?
So we're an investment sales company. So we help people with their acquisition and disposition primarily of the properties. Of course, there's ancillary services that we provide and some that we outsource, from helping people with 1031 exchanges to the financing of the individual properties to estate planning or what have you in regards to triple net properties. But again, mainly a brokerage firm focused on acquisition, disposition of these type of assets.
Awesome. How can our listeners get in touch with you, Randy?
Best way to find me is go to bouldergroup.com and hit the contact us page, or just go to LinkedIn and send me a connection request. Happy to help anybody with questions that they have.
And as always, all of these links will be under show notes. Randy, thank you so much for sharing your super incredible, amazing insights with us. And I would love to have you back here to share some more.
Stephanie, thanks for having me. Good luck with your show, and really appreciate being on today.
And I would love to thank one of our latest reviewers, Sean Evans Tampa. Amazing. I absolutely lucked out finding this podcast. It was exactly what I was looking for to educate myself for diversification of my residential portfolio with commercial real estate investments. The guests are top tier and on point. Stephanie must be one of the most selfless and helpful person in the world. Well, not that selfless, but I'll take it. Love the way she is absolutely honest about all the details, good and bad, of her investments. Binged on all the episodes and will listen to all again several times. Definitely signing up for the group calls. You should definitely sign up for the group calls. They have been amazing. Everyone is getting so much accomplished every week. This is our goals calls, and I will put the link again under show notes. It's been really amazing, and I'm very grateful for everyone that is part of it. Thank you so much, Sean, and I will see you guys next time.